if you only had $100, what would you invest in and why? This is a question that I see come up quite a bit in different forums, on Reddit, and in Facebook groups. So I want to answer it and give my own unique spin and my own unique perspective on what I would invest in if I had to start all over and if I only had $100. All right, so this is what I would do. All right. And just know that this isn't the best way. There's 100 different ways to make $1,000, to make $1,000,000, So again, this is just one of many different ways, but this is what I would do based on what the information that I have. All right. So I have $100 and I need to invest in at least 2 different funds because I'm a young, aggressive type of investor, right? I'm not nearing retirement anytime soon, and I want to grow my money as fast as possible. So I'm going to definitely go with 2 funds that come to mind. One of them being the all famous VOO, which is a S&P 500 index fund from Vanguard. The reason why I would choose VOO is because, one, you're obviously going to get instant diversification when you invest in these things. You're going to be investing in 500 large cap US based companies, which is a huge deal because if one of them, goes down, and this is kind of why I don't advocate for investing in single stocks in the early stages, so because if one of those stocks goes down and it goes down hard, you're going to basically wipe away some of your wealth, right? So you want to invest in an ETF, something with broad diversification that captures the entire market. And an S&P 500 index like Vanguard's VOO definitely does that, right? You're going to be investing in financials. You're going to be investing in banking, healthcare, technology, consumer staples, all kinds of different sectors, right? So you're covered there. The other fund I would invest into is a technology fund, right? Technology ETFs, technology stocks are very volatile. They come with a lot of high growth, a lot of higher risk, and definitely a lot of higher return, but they can also have a higher amount of loss, right? So I would go with an ETF because I'm not too smart at picking individual stocks, and I'd rather just capture the entire market. So I'm going to go with something like VGT, which is Vanguard's technology ETF. All right. So now I have my 2 ETFs. I have VOO, which is a S&P 500 variant, and I have VGT, which is Vanguard's, technology ETF. All right. So let's hop into the brokerage, and I'm going to kind of show you how I would structure this. Now, you can do this with Robinhood. You can do this with Webull, with Vanguard. You can do this with almost any other brokerage. It's really your preference. I just prefer using M1 Finance, and that is what we're going to use today. All right, so we're in our brokerage account, right? And I want to build a stock and fund pie, right? We're going to be building a portfolio of just 2 ETFs. All right. And this is going to give us huge amounts of diversification, right? Because when we're investing into the S&P 500 index, we're investing in 500 different companies. All right. And when we invest into VGT, there's 307 different companies, if I'm not mistaken. They're all technology focused, right? So we got some huge amounts of diversification there. Just between those 2 funds alone, you're getting almost 800 different companies. All right. So first, let's build out this fund, and then I want to show you kind of next, the overlapping between the 2 funds. All right. So we're going to call this new portfolio, and I would invest, like I said, into VOO, which is right here. And the reason being is because it has a super low expense ratio. The expense ratio is such a big deal, guys. If you look at my last video, I kind of break it down, about expense ratios. They could be the difference between $5,000 over the cost of the fund over the lifetime of the investment, or $75,000, right? So expense ratio matters, right? And that's something you want to always be keeping at the forefront of your mind whenever you're investing into these ETFs and these different things that these YouTubers and financial influencers be peddling. All right, so I'm going to go with VOO. And like I said, I want something a little more aggressive, something a little more riskier, something more growth oriented. So I'm going to go with VGT. All right. So we have to look for VGT. We're going to first add that. So now we're going to look for VGT here. And we just found it. Boom. All right, so we're going to add that to the basket. All right, so now comes the next question. How do we structure this, right? How do we structure this? We're going to call this aggressive portfolio. All right. If I was starting over, I had $100 and I want to grow this money as fast as possible, and I'm going to be putting in $100 every other week, or maybe, every other month, whatever. I'm going to want to do I would do 40% to Vanguard's S&P 500 ETF. And the reason is because, again, I'm an aggressive type of investor. I want to grow this money as fast as possible, but I also want to keep in mind risk, right? Risk is a big deal. I don't want to go all 100 into VGT, because if the technology sector takes a massive dip or a correction occurs, I could see my investment almost disappear, 20, 30, 40, or even 50%. So I want to be careful and I want to be cognizant of that. Now, by including a S&P 500 index, I kind of help mitigate that risk a bit while still being able to capture the gain of the market, right? Of all the other sectors that I'm not investing into when you invest into a technology, focused ETF. All right, so we're going to go with 40% to VOO, and we're going to go with 60% to VGT. All right, this is pretty aggressive. All right, and you can kind of play around with this if you'd like. You can do something like maybe even 70-30, right? This would probably be, in my opinion, a little more moderate to aggressive, because again, you're putting more emphasis on the Vanguard's S&P 500 index, which in my opinion is a very low risk type of investment. Aside from, bonds, the S&P 500 index is pretty low risk. Again, you're getting 500 of the best U.S. companies. And unless all 500 companies go obsolete tomorrow or bankrupt tomorrow, we probably have some bigger issues in the world going on if that was to ever happen. But ETFs are very efficient in that out of these 500 companies, if 2 or 3 flop, the ETF, the manager will just remove them and replace them with newer ones, new companies, right? So you don't have to do anything. It's all done for you. It's actually really, really efficient. And not only that, investing in the ETFs are extremely tax efficient as well. So we got 70-30 here. This looks pretty good to me, but like I said, I'm an aggressive type of investor. So I'm going to go with a 60-40 split. All right. And I'm going to hit save here. All right, so we're going to go back to my portfolio here, and we're going to look for aggressive portfolio. Boom. All right, and this is what it would look like, right? You can connect your account, obviously, to M1 Finance, and then you can start buying it. And when you buy or put $100 into this, $60 is going to go to VGT, and $40 is going to go to the S&P 500 index. Now, let's talk about overlap. When you invest in ETFs, there's a lot of companies, a lot of the same companies in a lot of these ETFs, right? And you have what's known as overlap. All right, so for overlap, we can use a special little tool, free of course, called ETF overlap, right? You can go to etfrc.com, the ETF Research Center, and they have an overlap tool. So I put in VOO and I put in VGT, and this is the results, right? There is a 31% overlap, or 67 companies that are in both ETFs. But again, out of a possible 800, out of a possible 800 companies, there's only 67 companies between the two that both are investing in, right? It's very low, right? So you still have huge amounts of diversification there, which is a good thing. Okay, and we know that VGT is obviously super heavy into tech, right? Whereas the S&P 500 index has financial services, healthcare, discretionary, communication services, industry or industrials, staples, energy, utilities, real estate, and materials, as well as some tech, right? So we're good there. We're really good. We have really good diversification. All right, now comes the fun part, right? How would these portfolios perform, against the S&P 500 index? And this is kind of what sparked this in my mind. Yes, everyone's going to say invest in the S&P 500 index. And that is good advice. That is great advice. I would advise that as well. However, I think you can probably get better returns, or at least, take on a little more risk and get better returns by investing in other ETFs that are more focused on growth. All right, so let's take a look at a hypothetical scenario here. There's a tool out there called Backtest Portfolio. Really useful. I would recommend you use it in incognito mode using Google Chrome, because you only get to use it 5 times, right? So if you use it 5 times, then you can't use it again. You have to use incognito mode. So anyways, you go to valueinvesting.io, look for Backtest Portfolio. All right, so I already filled it out for you guys, so we can skip that, but let's pretend like we're starting with a hypothetical $10,000, and we're going to be putting $100 in every other month. All right. And I started with $10,000. I know the question was starting with $100, but I want the amounts to really matter. And I want to show you, really what the differences could be. All right. So anyways, we're back testing since 1972, but this is really going to backtest since 2010, because that's when both ETFs were around at the same time. So that's when they collect the data. We're going to contribute a fixed amount of $100 every single month, and we are going to reinvest the dividends, of course, and we are going to rebalance once a year. Okay, rebalancing, if I have that 60-40 split, and let's say the S&P 500 is doing really, really well one year, right? And VGT is doing really terrible another year, right? Or that same year, I can rebalance them to bring them back to a 60-40 split, 60% to VGT and 40% to the S&P 500. So you want to rebalance. You don't want to do it every, it really matters to the investor. You don't have to do it every single year. I used to do it every single year, but now I've kind of scaled that back, and I'll probably rebalance once every 2 years. Really, it's all up to the individual investor. So anyways, we're going to compare ourselves to the benchmark, which is the S&P 500 index. I put SPY as our benchmark. All right. And we're going to have, so we have the benchmark. We have the moderate portfolio, which is going to be a 70-30 split, 70% to VOO and 30% to VGT. And then the aggressive portfolio, which is what I would invest into if I was kind of starting all over. All right. I would go with a 60-40 split, 60% to VGT and 40% to VOO. All right. So let's look at what that looks like. So I already clicked it for you guys because I ran these already, but this is what the numbers would look like. All right. So the benchmark, just a regular S&P 500 index, has only returned $116,000, almost $117,000, right? Over the investment period, right? Since 2010, right? We know that because we're starting here, 2010, and we're going all the way up to 2024. All right. So that's 14 years. You have an account balance of $117,000. That's really good, right? Especially since you're not actively managing it and you're just putting in your money. That's really good. Then we have the moderate portfolio, right? This is the 70-30 split, right? We have $145,000. Again, you're just putting money in. You probably rebalance once a year, once every other year, whatever, right? That is that 70-30 split. And then the aggressive portfolio, the one I would invest into because I want to maximize my growth. I want to grow this money as fast as possible. I would end up with $172,000, right? So between this and just a regular S&P 500 index, you're looking at almost a $50,000 difference, right? Really, really, really crazy. It's a really big difference, right? And that's with just taking on a little more risk. Now, of course, there's that, saying out there that past performance is not indicative of future returns, and we always want to keep that in mind. But again, taking on a little more risk, investing into higher growth ETFs, technology focused ETFs, those can yield great results, right? And it all depends on the individual investor and what their goals are. All right. So again, just to sum this all up, if I was starting all over and I had to pick, a couple stocks to invest into, and I only had $100, what would I do? I would invest into VOO, which is a standard S&P 500 index fund, as well as a high growth technology focused, higher risk type of ETF, VGT. All right, so I hope this video was helpful for you guys. If you guys have any questions or let me know what you would do, let me know down below in the comments. All right, I'll see you guys in the next video.